Okay, so let's go ahead now, navigate back to power options. We're going to change gears here from discussion on probability and delta, and we're going to just talk to Ed. And Ed says, hello, I would like to know about the strategy I use when I buy a LEAPS option and it doubles in price. Would it be smart to sell it or to sell a higher price option to cover the cost of the original? I don't know if what I'm asking makes sense. Ed, it makes perfect sense. And we have covered this before. And I'll try to find you that other link, but I'm going to go into the discussion again, and then I'll review back and see how off my discussion is here from what I presented before in this case. What I believe we talked about before the webinar, was managing a long call, managing a successful long call position. And so, what Ed is saying is, hey, I bought an option a couple of months ago. I bought a call option, a LEAPS call, a couple of months ago. And now it doubled in price. You've got 100% return. Would it be smart to sell it or to sell a higher price option to cover the cost of the original? The answer is either. And one other thing you could do too, Ed, two other things you could possibly do in this case, depending on what your expectation is of the stock. Now, I'm going to start off with a big runner today. It became a meme stock this week, it seems, came one of the Reddit stocks along with Robinhood, HOOD. But AMD has been on a rocket ship, since 2 weeks ago, 10 days ago, roughly. And there we go. Okay, so we were at 90, and this was back on, right before the volume kicks up. You can see the two charts there. We'll go end of July. That looks to me like it's going to be maybe July 20th, and we're around $90 or so, $92. We're going to go back in history to July 20th for AMD. We're going to pick a January LEAP call and see what it was trading at that time. And then we're going to roll forward to see where it is now. I'm pretty sure we're going to be at one. We're close. We probably should be double the value, but we'll check because it might have been volatile back here. No, I want to go further, but we'll start with July 20th. Okay, so let's see where we were July 20th. So on the historical tools, you can go back in time on the options research page, stock research page, historical options tools for the historical chain, which we're going to look at in a moment, or the back testing on the searches to find positions on a given day. But I'm just going to eyeball this. We're going to go back to July 20th. I'm sure earnings were coming up on July 27th, which helped prompted some of this movement. And there we go. Stock's at 87.11 on July 20th. I'm going to just take an at the money January 85 strike. I know it's probably going to be expensive because earnings were coming up, even though it was out to January. So let's take a look at our chain. Okay, and July 20th, and I want calls only. Let's get the chain first. And we want it just for, it's 184. Let's go to March. Okay, that's sort of a leap. 241 days out. I mean, the 6 months is okay, but let's go to, we could go all the way out, but we're just going to go to March, 241 days out. And the 85 strike call midpoint was 1188 on July 20th. Okay, so what I want to do now is enter this as it would have been on July 20th in the portfolio. And I'm going to do it twice for two examples. So let's go to the portfolio tools. And let's go to, what do I have got here? I got something recent. Okay, yeah, June 18th. I don't know what positions we put in. This is in the Berry discussion, it looks like. So we're going to enter in one long call. We got to put in our stock, AMD. I want the March 85 call, perfect. A little bit more than perfect, but still perfect. 1188 on July 20th. One contract. Oh, stock price at time of trade, 87.11. All right, so as we can see here, we're at 152% return. We've got a profit of 18.15 on a cost base of 11.88. Okay, so that worked out well. But we're going to do the same thing again. Sorry for the duplication, but I want to sort of do it this way. Not saying I would have done it this way based on my account size, but March again, 85 strike, 1188 on July 20th, and 10 contracts. Okay. So, in the webinar that we discussed about the profiting ways to adjust a profitable long call, we addressed it in a few ways. And let's just go to the profit and loss chart. What is the best thing to do right now with AMD? We've hit up a top, it's starting to come back down. MACD's closing a little, RSI is coming down from 80. Things are settling down a little bit. Are they going to settle back down to 90? Are they going to be another meme stock where they come back down and then shoot back up? AMD is not like the regular meme stocks we were talking about before. It is being talked up on the Reddit channels as far as I've read. But this is also a very strong company, and the semiconductors and things of that nature have been doing very well. It's, AMD with using the semiconductors and the devices and such. They're different than just a semiconductor stock, of course. But we could sell it right now, and you saw the profit we take, 152%. What does that give us? Well, number one, we're out of the position, got a strong profit. We can take those profits and try to find the next big mover in the next big trade. That's option one. Option two, we could sell a call against, now I don't know if I'm going to get 1188, but let's take a look. Might have to go out to September, even though we have weeklies. Let's see what's available on August 20th. With volatility spiking, the stock up to 110 now. Yeah, we're not at $18. We're not at the $11 that we paid. Okay. Your prices, Ed, might be different, but this is why I said I might need to go out to September to get closer to that $10, $12 view. I'm going to go standard September expiration. Maybe oh no, it's only half of that. Okay, so let's take half off the table to begin with. Or I could go out to October, but I guess if September is only at 495, 505, I'm saying probably December might be 10, and that's only a few months away from our expiration. I don't know if we want to stay in this calendar spread that long. So what we're doing is creating a calendar spread, getting close to half back, a little bit less than half back that we originally received. We're going to knock the cost basis down to 688. Max profit extends up to 2,625. If it's September expiration, AMD is back up at 115. So we're going from essentially an $1,800 profit to a $2,600 profit. But our original was an $1,800 profit on a cost of $1,188. Here we're looking at a $2,600 profit on a new cost basis or new risk of $688, which brings us to 381.5% return. Reasonable trade. Hedges half the cost, Ed, in this case, in this example, but not all of it. And it gives you some more movement for the upside. But then, of course, as the stock keeps continuing to go up, you give a little bit of that back, profit of 2,500 here at 130 at September expiration and so forth. Still very profitable against the new cost basis. Cut the risk in half, increase the profit. It's very reasonable based on what your expectations are for AMD going forward. Now, if you think AMD is going to crash back down to 90, I would probably just sell now, take the money off the table, and maybe buy a put now. I don't want to say it that way because I don't know what your expectations are, but that's one way to approach it. Another approach before selling this call, and other than just closing it out, I can take profit on this call and roll it up in price. So I'm going to sell to close my March now for about $30. That's going to give me an $18 profit. And I'm going to take that $18 profit and put it into the 105 call. So I'm going to sell that, buy a higher strike at 105. Now, you didn't lock in as much profit as I know you'd want, but what do you have now? You have a 105 call on AMD, and I know this isn't your trade, but you now have a 105 call still out to March expiration that you received at a credit of $19.50. And I could now consider doing the same thing I was just considering before. I can go back to September 17th or closer in if I wanted to and sell that 115 call. Now, this isn't going to give me as much profit as I saw with the wider strikes at 85 for 1188 and selling this call. But now I've got a credit of 1950 and I'm gaining another $5 for creating a calendar spread where I'm still out to March at the 105 strike. Sold is September 15. Now you're guaranteed a profit, $520. And you can still make $2,483, $2,600 less than just selling the call against the existing March option. Still getting $500 of credit in, which gives you that big bulk of that credit. What does that credit mean? That means you have a guaranteed profit. I know it's not great, but even if AMD pulls back to 50, you're guaranteed a profit of $500 with the potential to make almost $2,500 at the perfect time in September if AMD is at 115 and still being able to make $1,800 if it goes all the way up to 150. That's a strong position to be in, isn't it? But again, that depends on your outlook for the stock going forward. AMD is a specific situation. So this is what you want to evaluate at. If you think it's going to fall, there's two things you can do. One, take the profit now, be done with it. Be happy, look for a position where you think the new rise is starting. If I think the stock's going to fall, I can hedge it a little bit by selling that call. We didn't take too much off the cost basis. Or I can roll it up and then sell the call to give myself a bulletproof position to the downside with no risk on the trade and still have a strong profit on the position. Now, Fernando brings up a point that I was going to get to in time. If I want to stay in this position, but I think the stock is going to decline in price and then maybe move back up sometime over this next remaining 240 days to expiration, 220 days to expiration, I don't have any realized profit in this position yet. We've got $1,800 of unrealized profit. But I can say to myself, if I go out to March now, I could potentially buy, let's say, a 100 put for $10. Now, this is drastically going to increase my cost basis on the position. Let's just put this at 222, shall we? Let's just keep that a nice even number. There we go. So 2210. Now, didn't do what we wanted, Fernando. And even if because of the cost of the implied volatility, what Fernando was looking for is if we could buy a put and have a completely no-risk position with still potential to profit to the downside or the upside if the stock moved up. So Fernando was suggesting at the same price, buy an 85 call. I'm sorry, buy an 85 put for a lower price of 450 to have guaranteed profit on the position. I'm not sure. Yeah, that doesn't give me the guaranteed profit because the cost is 1648 and we're not there. How this, even going deeper in the money with these implied volatilities, wouldn't work in that case. But I'll show it. Fernando says go deeper in the money. Okay. But it's tough to do in this case because of the original time value that we paid. And now with the inflated implied volatilities, if I bought an in the money 130 strike, which I'd normally do for a married put on a stock that had moved up in price. Okay, there we go. We get to a bulletproof of 397. And then Fernando says sell a call against it. That's not what I would do. Okay, if I was doing this to sort of play, I think the stock's going to start to fall and then it's going to move back up, I'd wait for it to fall. I wouldn't sell the call because if I'm wrong, the way this stock has been behaving, and now you sell a call against a no risk strangle is what you're doing in this case. Did I? Oh yeah, I went to. Oh, I'm in the wrong expiration. That's fine. I'm sorry. So let's just go with the 113 call instead of the 115. Okay. See, this is what I didn't want. I don't want this low. Once you're in a strangle position and you sell a call, you create downside to the upside. So if you're wrong and this does take off again, goes up to 140, 150, you're giving way too much back because of that short call. If you're uncertain of what it's going to do next, this adds to the cost basis of the position, gives you a guaranteed profit on the trade. Okay. Yeah, and okay. So that's the options. So one is close and take the profit. Be done with it. Number two, yeah, sell that call as you did. And Ed, got back. He said my question was exactly about AMD calls. He did not mention that in the first one. I got a lucky guess there. He sold 2 strikes higher, and which he did that. Now I don't have to worry about it for a while. Okay, that's good. So that's what you did. Number three is you could roll up the call to take the profit on the long call and then sell the call. You saw that you had a bulletproof position, no risk to the downside after rolling up your long, and then sell the 2 or 3 strikes out of the money. No risk position to the downside, locked in profit no matter what happens, still potential upside. 4 is buy the put, as Fernando pointed out, but that was always going to be my number 4. Buy a 4 to create a no risk strangle. And then Fernando had mentioned selling a call against it, and that makes me nervous because the put combination now with the call combination, as the stock goes higher, the put time value paid into lowers. 4B would be the same thing, but you could roll up first, then buy the put, then the ITM put, and then consider selling a call, but would still have this level. So those are sort of the things that you can consider in these situations, Ed, that will work out for you. There's another thing that can work out extraordinarily well for you. With those similar concepts in mind, but doing something a little bit different. And that was the reason why I entered that other entry into the portfolio with the 10 contracts. Because now what you have the ability to do with multiple contracts, when you have a 100% gain on the position, what if I sold half? I sell 5 of those contracts for $1,880, whatever it is. You know, our cost basis was originally $11,800 for 10 contracts. So we're going to sell 5. Oh, I'm sorry, it's 30. It's $18 profit. I'm sorry. We're selling it at about 30.02. Okay. So what does that leave me with? That leaves me with 5 open contracts of the March 85 call with a net credit of $3,130. What does a net credit mean? It means I have a guaranteed profit of $3,000 on this position. Okay, 1/6 of what about 1/6 of what I had if I sold these out for $30. It was 18, so yeah, it would be $18,000 profit. So about 1/6. Sell half, even if you had 6 contracts or if you had 2. Sell half first to have a no risk trade. And now, what you can consider is with having 5 contracts bought at a net credit of $3,130, what if you rolled the remaining 85 up as we showed to get a further bulletproof status? Then maybe bought a put against that, only 5, to further have a bulletproof status and profit in either direction, or maybe sell the call against it as well. So those same 4, 5, 4A, and 4B ones we just talked about with just managing one call or managing all the calls that you bought, if you have multiple contracts, you may be in a position to sell half, lock in the profit, and then follow those other 4 patterns to increase break even. So let's say our cost basis, 5 contracts of the 85 call. How would I even reflect this? So that's $600, right? We'll call it 610. No, 605, somewhere around there, 615. So I'm going to put in a cost basis here of buying 5 contracts, negative 615. No, it's too high. No, maybe it's not. Hold on. Okay, 635. Anyway, okay, maybe it was 630. Anyway, okay, not a big deal. Let's just do 630. Okay, so a little bit higher, but that's what we're looking at right now. Now, what we could do is roll it up as we showed before, Ed. We could go back into March. We've sold half, locked in profit on the position. We sell the remaining 5 and buy 5. Was it the 100s or the 105s? I think it was the 105s. Yeah. All right. Guaranteed profit of $9,000. half of what we would take if we just sold to close the position now, but now you have more upside if AMD takes off. Or again, now that that's taken care of, I was using September, so I'll stay with September. And it's at the money, but I'll maybe use the 120. I'll use the 125 now that we've got $9,000 guaranteed profit in the position. And sell 5. Guaranteed profit of 10,500, still 8,000 off of what we have right now if you just sold to close it, but with the potential to make up to $23,000. The stock's trading right around 125 in this case on September expiration. So that's just another idea. The same 4 ideas we talked about, which you did, versus just taking the profit, versus rolling the put up in strike to lower the cost basis or bulletproof the position to where you have no risk, and then sell the call, or just sell the call as we talked about. Or with multiple contracts, with 100% gain, sell half to have a 0 risk position, then roll up the calls to get a further locked in profit to the downside, then consider selling it even though you only have half the calls remaining, and evaluate what your guaranteed profit would be versus your potential return to the upside in those scenarios. And that'll kind of give you an idea, excuse me, of which one is the best approach. So Ed says, I sold the 25 140 calls on AMD next year when it hit 120. Okay, so I got it. That's a separate position. And Ed says, thank you so much. I really like the way you're explaining things and really appreciate the simplicity of the platform. Yeah, well, thank you, Ed. I do appreciate that greatly. Believe me, it's always good to hear that the explanation came through well. And using this tool, you can see how you can use it to help you evaluate your rollout opportunities, adjustments in those scenarios, and other things. Now, also what I wanted to check while we're here, oh, sorry. I want to go back to the portfolio. I'm going to stick with the 10 contract one, Ed, because as you're tracking positions in the portfolio, you can usually go to position actions and then position analysis. There's our AMD position. We saw our current liquidation of $18,145 for 152.7% return. And if we held it all the way to expiration and stock remained at 110, we're going to give a lot back for the time value. That's just giving you a reference. But so here are some rollout opportunities. And you see here, you could create a calendar call and it walks you through the new break even, selling these calls, the maximum risk, and the percent return if assigned for selling these various calls. And here's the other rollout opportunity. Consider rolling your March 85 to a higher strike or closer in time. And this goes up to exactly the one I chose. No, I did not look at this beforehand, but that's the one we were kind of looking at, rolling up to the March 110 call. No, we used the 105. Okay, so I had the 105 in there. And then again, later we showed, I believe, maybe the 115 or the 110. No, I think I did use the 105. Sorry about that. But this kind of shows you the ideas to roll out your position. It doesn't have to be all of them. What's not shown here, it's just discussed. So it says, consider you're rolling to the higher strike, maybe closer in time to take some money out and lock in some profits, but still let the position ride. Or you could consider selling half of the position and make the remaining position bulletproof since all of your investment is recovered. These rollout opportunities walk you through those concepts when you have this 100, 115, 120% gain. Even if I only had an 85% gain, it would show me the rollout opportunities for the calendar spread concept, which you ended up doing, and also rolling up to the higher strikes to get the locked in profit on the position. The new negative max risk, of 227 here, the negative max risk of 370 there. That means bulletproof, no risk on the position, guaranteed profit. And then if I chose to do that, I could still sell the call against it. Now, it's great to see things numerically, and rollout opportunities will appear for most of those particular strategies. But again, it's great to see things numerically, better to see them graphically. You could go here, Ed, go to Simulate Trade, and you have a side-by-side comparison. My original position on the left in red, and my new position on the right in blue with the new comparative numbers. So you can get sort of a bird's eye view of the new profit and loss calculated out for you, shown in percentages, and then shown graphically. And then I could just decide if this is what I wanted, I could submit the change to the portfolio. And on the other rolls, We'll take a look at the March 110. Got a same box side-by-side comparison. In this case, the original position in red, that potential loss of 11,880 if AMD reverses back to $80 per share, unrealized return of 152.7%. Creating the roll up to the 110 call gives us a guaranteed profit of 2270 in this case, and that's the blue hockey stick graph here with guaranteed profit to the downside, still unlimited upside profit potential, and I could make that change right here to the portfolio if that's what I wanted to do, and then evaluate turning it into a calendar. Or use the profit and loss chart as I initially showed to walk through those steps, or to evaluate selling half what your new cost basis would be, and then going through those 4 other steps there to potentially manage your profitable long call position. Good review there of how to do it and what we're looking for in this case with the managing a profitable long call. I'm going to skip back over here, YouTube. I think I called it managing a profitable long. Let's try that. 8 ways to manage a profitable long call. So what you can do while you're waiting for this presentation, but in the meantime, later on, 3 months ago, we discussed the 8 ways to manage a profitable long call, the similar review of what we just did as well, with the 4 ways to do it that we discussed, and then also, of course, the 4 ways to do it after selling half of the available contracts to create the different position and then evaluate those other 4 adjustments. Or there were some other things that I'm missing in there that we didn't cover today, so that might also be a good review to do that too. Fantastic. All right, so that's what we wanted to cover there for Ed. Great question, Ed. Very timely question. As I mentioned, we've seen a couple of those stocks. AMD shot up today, or shot up that last 10 days. We've seen Robinhood now do the same thing after its initial IPO. Did it come back down to earth yet? Yeah, it came back down to earth, didn't it? Okay. I would say came back down to earth. It's still, 15, 20 points above where it was at IPO. So just struggled out of the gate and then just took off, and then it's given a lot back. So it's been a roller coaster ride as well, but there might be people here who got into long calls when those options were available at that time and got to ride that up, or they riding puts on it once it hit that spike up to the top and bought puts on it as well. Of course, we've seen some other good movers in the past few days. Of course, the stock gainers here. These aren't some of the major ones I was looking at, but we saw some strong earnings come out recently, and that pushed a lot of the stocks up and helped pushing us again to near new highs and near daily trading highs. That's it, BTBT. Yeah, that was the other one I was thinking of. Saw that pop up on the stock gainers recently. Highest stock gainers of the day. There it goes. It's it was this day here when it went up from 12 to 16, I believe, when it popped up there 2 days ago. So that's been a large run on that position too. And if you're lucky enough to be in calls there on BTBT, you're probably in the same situation to evaluate those 4 ways.